Hello everyone, this is David Presson, and I'm the Director of Investments for First Bank Wealth Management. To paraphrase Charles Dickens, it was the worst of times, it was the best of times. I'm of course referring to the stock market and what happened in the fourth quarter of last year versus the first quarter of this year. December of last year was the worst December since the 1930s. In fact, for the full fourth quarter, the S&P 500 fell about 15%, with U.S. small caps doing even worse, falling roughly over 20%. At the time, investors were concerned that the Federal Reserve would be too aggressive in raising interest rates, as well as the potential for global trade wars, which the media felt could lead to a global recession. Contrast that to today, where we've had the best first quarter for the S&P 500 since 1998, and U.S. small caps had their best first quarter since 1991. The S&P 500 was up around 14% for the quarter, and U.S. small caps were up around 15%. Think about that. Over the last 50 years, the S&P 500 has averaged about a 10% return for the full year. Yet in the first quarter of this year alone, we were up 14%. In addition, roughly 90% of all stocks in the U.S. had gains for the quarter. Outside the U.S., the news was also good. International indexes were up roughly 10%. And looking at other categories, real estate was up 14%, U.S. and international bonds were up roughly 3%, and commodities were up 6%. Contrast this to last year, where virtually nothing was up. In fact, the best performing asset category last year was a stodgy money market account, which was up roughly 1.5%. The sharp rebound that we've had so far this year in the first quarter is not that unusual looking at the history of the stock market. In fact, it's fairly typical that after a sharp sell-off, especially when the media is calling for further declines and the news looks bad, is when the stock market can have some of its strongest gains. As I've said many times before, some of the best advice I can give is to turn off CNBC. Don't worry about today's headlines or market action, but instead focus on the long term. Don't try to time the markets, and stick to your asset allocation plan, which should meet your long-term goals and objectives. The events of the past 2 quarters is a good example of how quickly fortunes can change and how listening to the media can cause you to take actions that you might regret later. So thanks for your time today, and if you have any questions or feedback, please send me an email at david.presson@fbol.com.